Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, we'll have full coverage on the September Consumer Price Index report as inflation comes in a bit cooler than expected. Plus, we'll break down what the data mean for the Fed's rate cut cycle. And we hone in on autos as Tesla, GM, and Ford all wrap up their earnings. All that and more on Market Catalyst. Let's take a look at the major averages right now. We are seeing a rally on the back of the CPI report as inflation did come in slightly more benign than economists had predicted, virtually sealing the deal for a Fed rate cut next week, although we'll see what happens beyond that. As the White House said today, this inflation report is likely to be a one-off as long as the government remains shut down. The Dow right now up more than 400 points, about 0.9%. The S&P 500 up about the same. The Nasdaq leading gains today up 1.1% as we see risk back on in this market and tech leading the gains. Looking at the bond market here, interesting to see yields not going further down. Now, following the CPI report, they did dip down further below 4%, but interesting to now see this perhaps because we're then not getting that data beyond today's reading. Perhaps then there is maybe a less chance that the Fed's going to be able to cut beyond next week's meeting because they won't have the information and able to do so. That's something that some of our guests have been telling us here today. Bitcoin going higher this morning as well. Still not back to the highs where we had seen it, but above 110,000 after we got CPI, and crude oil continuing its climb that we have been seeing. In fact, let me take a look at crude oil on the week because we have been seeing some gains here. Indeed, an 8% surge in crude this week after new sanctions on Russian oil giants. And then let's break it down and look at some of the movers under the surface within stocks here. We've got, as I said, more of a risk-on, cyclically led gain today. That means XLK, the tech stocks, are up the most, followed by the financials. Those are the only two groups outperforming the S&P 500 right now. And we've got materials and consumer staples that are actually lagging. Within large cap tech, pretty broad rally here with the exception of Meta and Tesla, which is falling once again today following its earnings. That takes its 2 days now seeing up by 0.4% here. Let's take a look at the 3-day chart. Here we go. Off by about 0.5% here over the past 3 days. So stocks like Google, however, are doing well today. September CPI reading rose 3% compared to a year ago. That was a shade better than consensus. My next guest says that is unlikely to sway the Fed one way or another ahead of next week's meeting. Plus, he says watch for value to retake the market spotlight. Joining me now, Brian Jacobsen, Annex Wealth Management Chief Economist and Strategist. Hey, Brian, it's good to see you. So CPI report this morning, it seems like most of the people we're talking to are saying next week's cut is pretty much a lock here. The question is, what do we do beyond that? And also kind of how you strategize around it.
That's right. Yeah, thanks for having me. And it was really exciting to actually get some data that we could dig into here. And apparently we're not going to be getting much more of it until the government decides to reopen. We'll have to see how that plays out. But in terms of the Fed, obviously the numbers that we got today, a little better than expected, so almost seals the deal for a rate cut. I'm very interested as to whether or not they'll also announce that they're going to stop quantitative tightening. I think that's actually a fairly high likelihood event. And what the big difference of opinion, though, there are still those on the Fed who are concerned about the lingering and protracted effects of tariffs on inflation. Whereas the other camp that's more looking for further rate cuts, they're more focused on the labor side. And so if you kind of think about the balance of risks when we have no data to base decisions on, I don't think anything that happens between now and then and even the December meeting is going to change their minds about where they stand on that issue. So it could be a divided Fed, but the majority rules, and the majority is probably going to be calling for that rate cut, not only in October, but once again in December.
Brian, on the inflation side, and fair feed through from tariffs, we are seeing some areas that are affected by the tariffs, those goods that are tariffed. And then we get this news once again that the administration is calling off talks with Canada. So all of these folks who are saying eventually we're going to see more tariff effect. Do you think that that is the case?
Well, I think we are seeing some of it, as you point out. If you look at like the household furnishings, furniture, the apparel, we even like video equipment, things like that. So you are seeing it in quite a few areas. It's just that for the overall picture of the consumer price index, imported goods is only like 16% of what people actually buy. So I think that maybe can help put it in perspective. The big driver of inflation is really services. And that's the part where it was reassuring to see like the shelter component actually moderating, going from about 0.4% month on month down to about 0.2%. So I think we are going to be seeing tariffs. And honestly, I think tariffs are more of a market problem than it is for an economic problem, mostly because what we're concerned about as investors is profitability. And if you look at, if you can't push price higher because consumers are still feeling the pinch, that affects your revenues, but your costs are going up. And so I think that really tariffs are much more of an issue for the markets than it is for the Fed and the economy.
And let's get to what you think people should be doing in this market, because as I mentioned, it's a risk-on rally again today. Large cap tech is leading. We are seeing some of these more speculative areas of the market, quantum computing stocks, for example, are higher again today. How is that going to play out given that macro backdrop you're talking about?
Yeah, it is very challenging. If you think about it, it's almost like investors are like if you have a cat and you have a laser pointer and you can keep them entertained for quite a long time and yourself entertained for quite a long time by shining that laser pointer, the cat chases that light. And it seems like that's what some investors are doing, chasing quantum computing and whatever else it looks like maybe the government is going to be taking an equity stake, right? And so that can drive the prices higher. But when I think about sort of the underlying fundamentals, the fundamentals of big tech stocks look very good in terms of the growth, but are the expectations too high? So in one of my notes that I put out, it was about how, I'm a big fan of the idea, look for growth, but don't just buy it at any price. Look for growth at a reasonable price as opposed to growth at just any price. And I do feel like there is that fervor in the market where people are kind of ignoring that, there's got to be a little bit of substance here to what you're buying. For that, I'm finding more of that on the value side of the spectrum than on the growth side. Not to say that, we're avoiding growth. It's just that, value is likely going to have its day in the sun. It hasn't for like the last 15 years, and maybe that will happen sooner rather than later.
And what do you think will be sort of the trigger for that kind of migration?
Sure. Well, I think part of it is if you think about growth right now, a lot of the big cap growth companies, they don't have a lot of debt, right? And so if the Fed does show that they are willing and able to continue to cut, not just once or twice, but actually a sequence of cuts, maybe 4 times, I think that could really benefit some of the value companies that do tend to have more debt. We're seeing it with small cap stocks. Now, granted, in small cap stocks, you have to differentiate between the profitable and the unprofitable, right? The Russell 2000, you've got them all in there. The S&P 600, small cap, those are the profitable ones. And so when it comes to the outperformance of the unprofitable versus the profitable, I would be looking for that to change as the Fed really signals that they are willing to continue to cut to try to prop up growth here. And then people are going to maybe be more confident that some of those value names, smaller cap names, are not going to be facing that policy headwind.
Brian, good to see you. Thanks so much.
Thank you.
Coming up, we've got a deep dive into Ford earnings, plus what's on tap for Tesla after a mixed quarter. Stay tuned. Shares of Ford are rising after the company shared a strong report for the third quarter, saying it would have raised its full-year guidance if not for costs between $1.5 and $2 billion due to a fire at an aluminum plant that's one of its main suppliers in New York. Notably, the automaker said it expects tariff impacts to remain steady at $1 billion in 2026, in line with 2025 costs and lower than its earlier estimate of $2 billion for costs this year in tariffs. Tom Narayan is with us now, RBC Capital Markets lead equity analyst of Global Autos. Tom, it's great to see you. I'm curious what you made of the Ford report, because it seems like that the fire recovery speed is sort of more encouraging, but how does that mesh with sort of the underlying news from Ford?
Yeah, I think most of us kind of already assumed the fire impact. And I think we had kind of a ballpark number of what it wound up being. And that is a one-time kind of event, right? I think they said they would recoup a large chunk of it back next year. It's not a significant volume hit. Um, but when I look at the forward results, I really look at the backdrop of what we learned from GM earlier in the week, which was that US administration policy shift a week ago was actually really significant. They changed the definition of the 3.75% offset on MSRP in terms of what parts qualify, and they broadened the scope of that. We saw GM up like 15% earlier in the week for the same reason. Basically, tariffs comes down a lot, and Ford did the same thing last night, cutting tariffs by about $1 billion for this year, and saying that next year would be around $1 billion as well, which is I think lower than what people were assuming. So really, that's I think what's driving the stock reaction today is that because of the lower tariff number for next year, consensus numbers, all of our street numbers need to go higher for 26.
Well, and Tom, I'm really curious, not just about the lower hit in terms of costs, but whether this makes these US made vehicles more competitive on price for consumers. In other words, are Ford and GM going to sell more cars versus foreign made because they can be more competitive on price?
Yeah, and I think, for the longest time, this was a big debate point because, does Ford and GM really compete with where, Mercedes and BMW and Porsche are? Not really. The Japanese and the Koreans, maybe they don't compete as much head on. So I do think it'll be a net benefit. I think Ford and GM and Stellantis, by the way, will get USMCA, either Mexico or Canada relief sometime next year, and that'll be to their advantage. But yeah, I mean, how much do they really compete head on as a person buying a Mercedes, the same one buying an F-150? So on the margin, I do think it'll help those companies, but I think the real benefit to the Fords and the GMs will come from lower tariffs relative to what the Europeans and the Japanese may ultimately wind up paying.
Gotcha. That makes sense. And Tom, all of this said, you're still sector performer on Ford, neutral equivalent rating here. What would need to change for you to say that investors should come in and buy here?
Yeah, and we've been getting incrementally more constructive on the name the past couple of earnings. Obviously, last night was a big positive. The one negative there was the EV losses. If you notice, they actually got worse in 3Q versus 2Q. Their total EBIT is around $6.25 billion this year. EV is a negative $5 billion of that. So what if that gets worse? What if that becomes negative $6 billion? Now, so that really eats at your profits. I do think ultimately they'll do what GM did, which is impair the EV business, just take a big hit, a one-time hit. That'll be costly one time, and maybe it'll relate to retooling plants to make ICEs. I don't know what that number is. I'm still waiting to see if they do a big impairment charge, how much that'll cost them. So that's really what I'm waiting on to see if they can kind of stem those EV losses and how costly it'll be to pivot away from EV towards ICE.
Speaking of EVs, I want to get your take because we haven't had a chance to talk about Tesla since it came out with its numbers. And I'm curious, where do you think the growth is going to come from for Tesla for the next year?
Yeah, I mean, you and I have talked about what I think about Tesla a lot.
Yeah.
Ultimately, I think it's largely decoupled. You've seen that from the stock price the past year from being a car business, right? I think folks really look at this as a robotaxi business and now a humanoid robotics business. It's really all about AI. We'll be looking at data points like robotaxi launches in different cities. That'll be an interesting metric. FSD approval in Europe and China. I don't know if we'll learn a lot about humanoids anytime soon. I think that's a very long-term thing. But certainly the car business, I think folks are they get it. Like, They're going to be spending a lot of money on AI, so that's going to hurt profits. Maybe they don't sell as many cars next year, right? I think people are digesting that. Those folks who want car numbers, I don't think are going to be very happy. Those folks like me who view this more as an AI company, I think will be looking at kind of big picture thematic type data points. And I think that's going to be reflected in the stock.
Do you want an optimist in your house? I don't want an optimist in my house, Tom.
Maybe not now, but do you remember the Jetsons, Rosie the Robot? I'd love someone to iron my shirts and do a lot of that stuff. So maybe someday.
Rosie's a lot less ominous than those optimists. Right. Maybe they can make them like, I don't know, something, a little more of a friendly vibe, something. Tom, I got to ask you about General Motors too, because those shares are trading at a record, which is kind of amazing given the past couple of years that the auto industry has had. And you are still a buy equivalent on this one. What do you think GM really needs to continue to deliver on to continue to push that stock higher?
Yeah, I mean, GM just has done everything right? They didn't go down a rabbit hole with EVs too early, with dedicated plants taking huge losses. They did the impairment charge, got it out of the way now. They're not really in Europe, which is a blessing right now. A lot of the European companies I cover now, it's really difficult there. Their China business is not really a concern because the cash is contained there. They're buying back a bunch of stock. They have 60 to 70% of the large SUV market in the U.S. Some of it maybe is luck that they just have all the right things, but they've also been just making the right steps. I think it's a continued show me, prove out story that they have been doing. And tariffs, it's coming down. Mexico, they're really exposed there. I think we're going to get a resolution next year, either by June or maybe even earlier, that helps them. And then what they do about Korea, do they get out of Korea? We'll see. That'll be a big benefit if they can do that without being too costly. So I think they're just doing the right things. Some of it is luck, maybe. They're just in the right place at the right time.
You make your own luck, some would say. Tom, it's good to see you. Thanks a lot for joining us.
Sure.
The reemergence of volatility in the market might give investors some angst, but it also gives them an opportunity to diversify their portfolio and cover their bases in the event of extended turbulence. Joining me, Tyrone Ross, 401 Financial Principal and founder for this week's FA Corner, brought to you by Capital Group. And Tyrone, I wanted to talk to you about this because everybody has been saying diversification to me lately. Like, that is sort of it's sort of an old school buzzword, but it's become a buzzword again. And so when you're talking to your clients, I guess I should ask, first of all, if they're worried about the broader environment and if you're telling them to diversify.
So yes, they are worried. It's palpable. And also, to be frank, other financial advisors are reaching out to our firm about their clients being worried. So I think it is a concern out there amongst not only our clients, but everyone generally. It's just a lot of things that are happening at once. Diversification is always, 101 when it comes to investing. Obviously, not putting all your eggs in one basket, as our grandmothers used to tell us. But how you diversify, what does that mean, right? Is that going to cash? Is that, buying puts? Is that a little gold allocation, some alts, whatever that may be? Again, time horizon, age, goals matter here. But I do think diversification right now is prudent based on what your goals are and where you sit looking in the market.
So let's just take an example, Tyrone, because I know a lot of your clients are on the younger side, and so maybe they have a larger risk appetite. So if I'm many years away from retirement and I'm trying to build up to that goal and I'm young, how does that diversification look for me, versus somebody who's older?
Well, here's what we say and here's what we do. We try to obviously get young clients just into the market, right? Because concentration helps build wealth as you go into your peak earning years, right? Diversification helps you keep it. So we want to get them exposed to markets. Obviously, there should be a greater equity allocation there. But I think you don't want to get into the position now where you are 25, 35, even 45 years old and being so shocked, right, or appalled by what's happening, that you don't invest in the market, and that you kind of, again, you're in cash too long, or you don't really want to expose yourself. So again, diversify in terms of education, diversify in terms of different asset classes for sure, but be exposed enough and take a little bit of concentration risk so your upside is higher.
And you guys have some expertise in crypto in particular. So what role does that play in this whole diversification discussion?
Well, I would venture to say we're probably the most crypto forward RIA in the country. So we are more than a little exposed to it. But I think so. We have a lot of clients that come to us that own a ton of it. We try to make it a prudent part of our conversations with clients. I've been saying that this is the first time in my career as a financial advisor, and I've been in crypto 12 plus years, where I felt like I had a fiduciary responsibility to at least have the conversations with clients. So we think it's a core part of what folks should own. If folks aren't ready or they're fearful, we lean a lot on education. We educate a lot. We make it a part of every conversation, even if they don't own it. So they start to feel our comfortability. My partner and I, my CIO of our firm, my partner, Eric Smith, again, we've both been in it a long time. We're overexposed to it as financial advisors, but we know it inside and out. And I think clients trust us for that. But I think we try to make sure that, one, clients are educated, two, they get access through us, trusted fiduciaries, and then also we get them some exposure meaningfully based on age and what their goals are.
Tyrone, good to see you. Thanks a lot for joining us.
Thank you so much for having me. Have a great weekend.
You too. That was FA Corner, brought to you by Capital Group. All your markets action coming up. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke Topama. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Intel, Deckers Outdoor, and eBay. First up, Intel. That stock saw its biggest intraday jump since April 2024 after 5 financial firms, including Roth Capital Partners, Benchmark, Melius, Barclays, and Truist, all raised their price target on the stock. Benchmark now has one of the highest price targets on the street of $50 per share. This comes after the company beat earnings expectations in its Q3 report and is seeing demand accelerate thanks to, AI. Next up, Deckers Outdoor. That's the company behind Hoka sneakers and Uggs. Both Raymond James and Telsey Advisory Group cut their price target on the stock after the company provided a weak 2026 sales forecast, citing slower growth for the Hoka brand and a lagging direct-to-consumer channel. Now that's on top of margin pressure from tariffs and promotions. The stock is taking a dive today. It's the lowest it's been since 2023. And last up, we're taking a closer look at shares of eBay. Citizens upgraded the stock to outperform from market perform. The analyst there cited eBay's product improvements are creating a, quote, significantly better consumer experience, especially in fast-growing categories like watches and sneakers, parts and accessories. The analyst believes that could drive up gross merchandise value in 2026. We also got a call out from Stifel. They raised their price target on the stock to $89, and that's just below the average 12-month target price of roughly $92. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Eli Lilly, Newmont, and General Dynamics. First up, we got Eli Lilly. The pharma giant reached a deal to buy Adverum Biotechnologies for $3.56 a share. That price could reach $12.47 a share due to contingent value rights. That's basically if certain performance milestones are met. Adverum is a company that works to treat blindness. It's a part of Eli Lilly's push into gene therapies. While some drug makers have abandoned gene therapy research, Lilly is still investing in that technology. And shares of Eli Lilly are up, and shares of Adverum, as you might imagine, are also up sharply today, although they were up more. Now they're up about 3.5%. Next up, we have Newmont, the world's largest gold miner, delivering stronger than expected quarterly earnings. The company reaping the benefits of cost-cutting measures. Now, earlier this year, Newmont saw gold mining costs hit an all-time high. The incoming CEO said deliberate efforts to simplify the organization and drive down labor and contractor costs led to the results. Newmont expects to realize the full benefits of its cost savings initiatives in the next year. The company also benefiting from record gold prices. The shares are up about 140% this year. They're down about 4% today. And General Dynamics, those shares hitting a record intraday high after its earnings results. The defense contractor posting higher third quarter revenue and profit. That was driven by increased orders for business jets as corporate profits continued to grow and a new tax law offered companies incentives to buy planes. President Trump's tax bill signed earlier this year also allows businesses to deduct the full cost of a new or used business jet in the first year of acquisition. We have really seen a rally in shares of aerospace and defense stocks overall, and GD has participated in that. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we got much more markets action. You're watching Market Catalysts.
All right, P&G out with a better than expected quarter and a reaffirmed outlook. Let's welcome in P&G CEO John Moeller as always. John, it's a treat to get some time with you here on earnings morning. Look, there was some caution on the street about your quarter coming into these results. I think you put a lot of those concerns to rest, but what do you think the street got wrong? Because you're posting a pretty big earnings beat here.
Well, I honestly think that caution is warranted. Not only for the quarter that was just completed, but the quarters ahead. And that's just based on a lot of uncertainty that exists in the minds of consumers. Whether that's uncertainty regarding immigration status, employment status, what's inflation going to be, what about interest rates, reduction in remittances to countries like Mexico. And markets are slower than they were a year ago and certainly 2 years ago. But within that, as you've said, consumers continue to search for products which make a difference in their lives in categories where performance drives brand choice. And we grew organic sales for our 40th consecutive quarter. With that come the earnings that you referred to. We're on track to deliver core earnings per share growth for 10 years in a row. And the growth that we see is broad-based across categories. 8 out of 10 categories held or grew sales. 6 out of 7 regions held or grew sales. So it's tough. There's a lot of uncertainty. It's very competitive. But our innovation is carrying us through as it continues to delight consumers.
The two businesses, John, that came in strong and that were really, I think were the drivers of these results, it was the beauty business and grooming. Within those two businesses, why did they do better than, let's say, a healthcare, fabric care, and baby care?
A lot of that is the timing and sequencing of innovation. So, for example, we have big innovation that just came to market in September on fabric care, our biggest laundry upgrade in 20 years, Tide Boost. And we likely have the introduction of our new functional fiber detergent, brand new form to the market in the latter part of the year, whereas the innovation, very strong innovation in hair care and personal care occurred in the first part of the year. So that's primarily the difference that's driving the outcome.
One of the analysts I talked to, John, ahead of this quarter, they mentioned to me that you have a slew of innovation coming over the next 12 months. Outside of the detergents that you just mentioned, where else will that be?
To be announced when ready, but pretty much across the board.
Yeah, but leaning into detergents.
Leaning into all categories. When we reshaped this portfolio several years ago into 10 daily use categories where performance drive brand choice, we had a strong conviction that each of these categories would respond to innovation, communication of that innovation, solid commercial execution of that innovation. And that's a belief that we continue to test, but hold on to. So these are all very attractive categories to be in structurally. They all have the potential to growth. If you look at something like laundry scent beads and think about upside potential there, we're only in 20% of households. And within those households, load penetration is below 50%. So there's significant opportunity for growth, even in a very mature market in a relatively mature category, and that's true across the board. There are also significant opportunities to improve delight, and we're working hard to increase the execution of our strategy. One component of which is increasing delight in an integrated way across the 5 vectors of superiority: product, package, communication, go-to-market, and value. And obviously, those all go together and work together. And when we get them all right, the world changes.
Another industrial giant, John, Ford, came out last night, lowered how much their profits will be hurt this year because of tariffs. I think they cut it by $1 billion. And within that billion, they are cutting costs, raising prices to even offset that $1 billion. Have you been able to fully offset tariffs in your business?
Generally, yes. The picture has improved, and we're doing the things that you mentioned. We're reducing costs. There's a modest amount of pricing that goes along with that. But generally, things are in decent shape.
I believe P&G announced a little while back price increases on 25% of the portfolio. What has been the response from consumers to that?
The pricing that we are taking is just hitting the market. It hit the market in September, so it's a little bit early to see the total response to that. But I don't expect it to be significant because we've combined that pricing with the introduction of some of the innovation we were talking about earlier, so that ideally, and it's certainly our intent, value as perceived by the consumer, as received by the consumer, actually increases, not decreases. And that's been part of our fundamental business model for over 185 years. Pricing has been a component of our top line growth for each of the last, I think, 20 years, and pretty much every quarter. So it's not above, if you will, kind of normal levels of pricing that are supported by very strong innovation, which is value accretive and actually contributes to consumer delight.
I'm interested in the consumer caution you called out, John. Look, the iPhone, it's an expensive thing, over $1,000. I mean, demand seems to be really strong based on everything we've seen over the past week and a half. Talked to GM's CFO Paul Jacobsen earlier in the week, telling me demand for higher options on trucks are selling out like hotcakes. Where do you see the caution in what you're selling?
It's the amount of product use. So we're not seeing trade down. If you look at private label shares in both North America and Europe, they're actually down modestly. And that would be, that's a good indicator of how consumers are responding to price tiers across the ladder. And we also have very strong product offerings at different tiers in that ladder. But they are being a little bit more, they're reducing their household pantry inventory. Retailers have reduced their inventory, and they're being a little bit more cautious in terms of the number of loads of laundry they do, how much detergent they use with each load, and that's impacting the market growth, which is still positive.
I know the mobile phone industry hasn't seen an impact from immigration, but you mentioned it earlier. Have you seen an impact in your business from that?
Certainly, the confidence of that population is down significantly, and I can't tease that precise impact out of our numbers. But yes, I would say it's on the margin. It's been a headwind.
Interesting, John. Before I let you go, this is your last earnings day before you step into a new role. I suspect, knowing you will not be taking any vacation. You're still going to be involved with P&G. I mean, what will be your plans during this transition period?
My plans are to deliver and to help. Very simply put. And
you'll be what, executive chair?
Correct.
How would you sum up your time at P&G? What is there, if I had to write a chapter on you, how would you summarize it?
Well, I would quickly transition from me to we. This is big multinational business, particularly in the times we're in, is not a me sport, it's a we sport. And I would be reflecting back on the team, the quality of the individuals, their dedication, their energy, their commitment, their ability, their desire to continuously learn. It's been a wonderful, wonderful journey with this group of people and the people before them. So that would be my first, second, and third thought.
Quantum computing ones. They're rising on a Wall Street Journal report that several companies are in talks to give the Commerce Department equity stakes in exchange for federal funding. Joining me now at the desk to explain why the U.S. might want a piece of the quantum business is Yahoo Finance tech editor Dan Howley. And it's really interesting. I talked to Alan Baratz, who is the CEO of D-Wave, one of these quantum computing companies, just last week. And he said China is ahead of the U.S. when it comes to quantum. And he was calling for, if not this kind of investment, this kind of, interest and a push behind it in the U.S.
Yeah, I mean, we have seen an increase in quantum investing from the likes of Microsoft, Amazon, Google. IBM has been in the quantum space for, it feels like forever. So you can't count them out when it comes to this idea of quantum. But yeah, this is kind of, it's not necessarily the future of all computing. It is a future of computing. I think the thing that people might get wrong when it comes to quantum computing is that they're going to be, the new CPU, your central processing unit, your regular computer, your smartphone. The way that some experts I've spoken to have phrased that is like taking an F1 car to the supermarket. Like it's impractical, it's unnecessary. These computers are also massive. When you look at them, they don't look like your standard laptop.
Right.
These are in a facility. They have to be shielded from the outside world. Things like hydrogen molecules from the air can mess up the calculations that they're doing. They're dealing with subatomic particles that are called qubits. So when you look at a regular CPU, it talks to the different parts of the computer using ones and zeros. It's called binary. It's the base computer language. And then everything else kind of builds on that. So when you swipe, eventually that's translated into a 1 or a 0, and it's giving the processor instructions, or and vice versa. These qubits exist as ones and zeros at the same time. So what that allows is for them to do parallel processing, and essentially that means that you would be able to do calculations that would have taken classical computers potentially tens of thousands of years to complete. So it's a powerful technology. And the folks that I've spoken to in the past have said it can influence everything from healthcare to sciences of materials, coming up with new types of structures, things along like big questions, right? We're just not there yet. And so it's a matter of researching it. And there are folks who will say, well, it's right around the corner. It's been right around the corner since like the 50s. And so there's constant advancement in it for sure, but it's not to the point where it's like, all right, well, tomorrow I'm going to be able to walk down the hall, flip a switch, and turn on a quantum computer. But it is very important to get into because on the world stage, if you don't want to cede the lead in any kind of technology,
right,
you need to make these kinds of investments.
90 minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets. And first, we start with the major averages here, taking a look at the rally that we continue to see in stocks. Of course, we got the consumer price index this morning coming in more benign than had been estimated. We also, by the way, in the last hour, got consumer sentiment figures from the University of Michigan. Consumer sentiment reading at a 5-month low in October. Part of that has to do with the perception of inflation. So ironic on a day where we get an inflation reading for September that showed it's still rising, but not as much as economists expected. We get a sentiment reading that shows that people don't like inflation, even if it is moderating according to the numbers here. So the sentiment index at 53.6, 55.1 was the reading in September. And by the way, it was lower than economists had estimated. All of that said, we're still seeing stocks hang on to healthy gains, and we're seeing economists and the market expect a cut from the Federal Reserve next week and perhaps another one in December. And let's focus in on one stock, though, and that is Intel. Those shares are rising, though they are off the earlier highs, only up about 0.5% right now. Initially have been boosted by a surprise earnings beat, and CEO Lip-Bu saying AI is accelerating demand for compute. Our next guest, one of several analysts who raised their price targets on the stock today, still our guest saying the fight is far from over for Intel. He's still got a market perform rating. Stacey Raskin is with us, Bernstein Managing Director and Senior Analyst. Stacey, you said in your note you were surprised at that initial pop in the shares, and indeed, it's kind of coming back down to earth.
Yeah, I really was. I mean, look, on the surface, it was good. You know, they beat the quarter. Core markets, PCs and servers a little better, which I think should have been expected, but they were a little better. And they said they were actually supply constrained. They said demand exceeds supply. So that on the surface, that sounds good. And I think that's why the stock was up. But you start to dig in. The reason they're supply constrained, it's on their older generation parts. They're 10 nanometer and 7 nanometer parts. That's because their older parts at this point are offering more value to customers than their newer parts. And frankly, they've gotten rid of like equipment to make those older parts a few quarters ago anyway. So that's actually why they're supply constrained, is because nobody wants to buy the newer stuff. And then, he made some comments on 18A, which is their new process that they are now ramping into production. And everybody's been concerned about yields and everything. And he basically said, the CFO said, yields are kind of adequate for the ramp, but it doesn't sound like they're in a great place. And he kind of suggested they wouldn't be in sort of like where they really want them to be probably until the end of next year. So it does sound like that yield ramp is taking a while and maybe longer than people expected. And so you start to tie all of that out, strong demand, which by the way is probably temporary, like it's Windows end of life and everything else. Tight supply, but it's because, they're people are buying the older stuff rather than the newer stuff. And then like a yield trajectory that actually didn't sound that great. I'm actually not surprised it's coming back to earth now. This is more in line with what I might have expected. Maybe it just took some time for people to dig through the results, because the headline numbers were actually pretty good.
I mean, and even if you look at the sort of breakdown in their various businesses, they did see a boost in revenue in their biggest business. That's the client computing group. Revenue there was up 5%, but revenue in data center fell 1% year over year, and foundry revenue was down 2%. So where is the opportunity, the biggest realistic opportunity for growth if you look over the next year?
Yeah, you bet. So number one, don't look at the foundry revenue. That's internal. That's what they're charging their product business to use the fabs. That gets netted out, so that doesn't mean anything. Client was strong. Look, PCs are pretty strong right now. I think PCs from an end market shipment basis were up almost 10% sequentially. They're pretty strong. That's the Windows end of life, though. I mean, we've seen those cycles in the past. I actually worry. I think PCs this year in general will be pretty good. I worry that it makes next year tough, because that end of life process doesn't last forever. And then on the server side, they're claiming supply constraints, like limiting some of this. In fact, if you look at next quarter, they're actually, because they're limited on supply, they're going to prioritize servers. So they actually guided like data center up pretty meaningfully sequentially into Q4, and they guided client down because they're trying to parse what they use their capacity for. If I'm looking out into next year, like what drives the growth, I mean, one might hope that the server market can offer some growth. It's been pretty weak for a while. Maybe that's coming back. Although even there, they're losing a lot of share to their competitor. On the client side, I'm not actually convinced that this upside sustains. And I actually think that CPUs have been overshipping PCs for the last 5, 6, 7 quarters pretty meaningfully. So I worry that impacts the PC opportunity next year. And then on the AI side, I mean, they're trying, but I mean, they don't really have much of a roadmap to speak of, specific on like AI accelerators and things to compete with NVIDIA and others. I still think it's going to be a slog. Like I said, I mean, I don't want to be too like they're in a better place. Like they got the balance sheet in a better spot. Again, it came at a pretty high cost given all the dilution, but they got cash on the balance sheet. They're taking some of the debt off. They are ramping some of the new stuff, and at least in the near term, the core markets are a little better. So I mean, I don't want to take that away from them. But we are very early on this turnaround. I mean, like I always say, I've said this before, it took 10 years to break it. It's probably going to take 10 years to fix it. We're very early in that. And I think it's too early, much too early to claim victory here. And again, I think we're starting to see that a little bit this morning.
Yeah. Hey, Stacey, we were just showing the influx of investments that Intel has gotten. And we know the highest profile ones from NVIDIA and from the government, but you have the SoftBank investment too. What does that do for Intel ultimately?
Well, I mean, it gives them some breathing room, right? Yeah. I mean, they were burning considerable amounts of cash. They had a lot of debt, and so that was causing problems. And frankly, to the extent if they actually are going to decide to build out, 18A and 14A and build out a foundry business in a bigger way, they need cash to deploy that capacity. And so, but they got even more than this because they sold half of their Altera business and they sold some Mobileye shares in the quarter too. So all in, once they get the NVIDIA money, it's probably closer to $20 billion. Yeah. So that clearly helps, right? And again, it buys them some breathing room. So like that's all good. And if they decide to build that capacity, it gives them a little bit more of a window to build that. Again, though, before they need the capacity, though, they need customers. And before they can get customers, they need to prove that they have capability. And they said good things. Yes, they said we're more positive. Unfortunately, we've got a lot of quote unquote engagements. Yeah. Again, it's still very early. We probably won't know for another 18 months whether or not like 14A is really going to be good enough, like to drive like material like customer commitments or not. And again, they've even said they're not going to put capacity in place until they have those commitments. It's going to be a while, but the money at least certainly does buy them some breathing room. They're not quite in quite of as precarious a position as they were, say, 6 months ago.
Stacey, before I let you go, I got to ask you a question about AMD too, because this stock's ripping again today. It's up 7%. Oh, yeah. It's at a record. And it's just so interesting because NVIDIA has dominated the discourse for so long that AMD kind of snuck in here. You've got a market perform, I believe, on AMD. Yeah. What do you think happens now?
Yeah, and I always say, I'm always the wrong guy to talk about the bull case on AMD. I've never quite been able to make a successful bull call on the stock, so I'm always the wrong guy to talk about it. However, I'm not surprised it's running today because, again, just based on what Intel said, if they are supply constrained, if the demand is actually there, that demand is going to go somewhere, right? And AMD is the next one in line, right? So I'm not surprised on that. And then on the AI side, you have to remember, NVIDIA has dominated, and they're still dominating. That being said, like the call on AMD for a long time was like, hey, Lisa said it's a $500 billion opportunity. If they just get 5%, that's $25 billion, which the street's probably there now on the back of the OpenAI stuff. But for AMD, that's enough. They don't have to go out right now and do, $200 billion in AI sales like NVIDIA probably has to. And again, AMD to their credit, they're slowly but surely trying to crank away. Now NVIDIA is not standing still. Like it's very, very difficult. But I mean, the idea that the market is so big and AMD can get a little bit of a slice, and for them that could be big enough. I mean, I understand that. I also think tactically, we wrote this a few days ago. The near-term setup into AMD's quarter is probably pretty good. Again, given Intel's issues, that there may be some upside. The end markets are pretty good. Again, servers and things are good. These are all end markets where they've been taking share. And if you think about the last few quarters for AMD, what's disappointing on their earnings has been the near-term AI numbers have been kind of lackluster. Right. Even if they are lackluster, still, does anybody care? Because everybody really now is in it for the OpenAI deal. That doesn't come for a year. So, right now you can dream it can be as big as you want, right? So even if the near-term stuff is still lackluster, I don't know. But even if it is, I feel like maybe it just doesn't matter as much, given people are looking, to the end of next year, for that OpenAI. Yeah,
maybe that's the headline for this whole industry for the next year: when dreams meet reality. And maybe it'll be match their dreams. We'll have to wait and see. Stacey, thank you so much. It's good to see you.
Yeah, you too. You too.
Thanks. And a brief programming note for more on AI demand. You want to tune into Yahoo Finance Invest. That is Thursday, November 13th at 8 a.m. Eastern. We will be talking about it throughout the day. Coming up, a look at how luxury sales are faring amid the U.S. trade war and a look ahead to retail earnings. We'll be right back. As inflation, tariffs, and a weakening job market have weighed on consumers, high-income consumers have continued shopping, taking on a record share of total consumer spending. But is it enough to keep the luxury retail sector afloat? Earnings from names like LVMH, Kering, and Prada showed some improvement, but my next guest says there are still headwinds ahead. I want to bring in Pauline Brown, former LVMH chairman of North America. Pauline, it's always great to see you. So we did get those numbers from those various luxury companies recently. Is there a through line for them all, or are they pretty idiosyncratic?
There is a through line. I think the through line is, number one, that China, while still anemic, is stabilizing. It was a big, heavy, unfortunate anchor for many of these brands for a long time. And then the second is that some of the categories of luxury seem to be doing fairly well, nowhere close to where they were just 3 years ago. But I think the heavy anchor at the moment, which is certainly weighing LVMH down and a few others, is luxury fashion.
And what's going on with luxury fashion?
If you just look at the LVMH portfolio, by far the biggest growth segment was specialty retail, led by Sephora. That was up almost double digits. I think it was 8% up. Fashion, which is led by Vuitton, but also Dior and several other brands, was down 2%. And that is not a very exciting growth figure for a company that depends on its fashion segment. And I would say when you look at other companies that were doing quite well, relatively well, they had a bigger reliance on non-fashion businesses, whether it was in accessories or jewelry or beauty.
We've seen a bunch of designer changes at a lot of the higher end fashion houses. Do you think that's going to work to revive some of the demand?
It's definitely reviving buzz, and it's reviving interest in the shows as a curiosity. It's become a bigger entertainment factor. I personally do not think that is going to translate into the kind of growth figures that most of these houses depend on. I think there's a few standouts, but I think for most of them, it's going to be more chatter and less commerce.
Pauline, I'm also curious of the effect of tariffs, right? We just got a consumer price index number today. Apparel prices did rise, right? Things like home furnishings rose. How are these companies, particularly the European companies that are bringing their goods into the U.S., how are they navigating all of that?
It's tricky. I did note that Hermes is already planning to take price up as of May. That is a brand that actually can, as high priced as it already is, there's an utterly price-insensitive consumer for Hermes. When you look at a few of the others like Chanel and Vuitton and Dior, I think they've already taken price so aggressively in the last 5 years, there isn't much wiggle room. So I would say they're going to have to eat some of the margin on that. It's one more headwind against several others.
And speaking of headwinds, this is something that I wasn't tracking as closely, but I know you're very aware of it. I mean, the Louvre theft got a lot of headlines, but as you point out, there have also been some thefts at high-end stores. So that's something that had plagued sort of the mass market retailers and has for the last few years. Now, is it coming for higher end?
Well, very specific in this case to Paris. The last 2-3 years, there were quite a few high-profile burglaries of flagship stores. It happened to Chanel, it happened to Balmain, it's happened more than once to Vuitton. They tend to not get the kind of headline that the Louvre did. But I think what that puts a damper on is not global luxury, but definitely an interest in travel to Paris, which depends on tourists in order to move its luxury goods. So I think if people feel unsafe, I think they will think twice about spending their money, at least toward that destination for the time being. Do I think it's going to have a long-term effect in and of itself? Of course not. This is not the first time in history we've had, a heist of of enormous proportions. It is probably the most expensive one in history, and it's very unfortunate. And I do think in the short, maybe to midterm, it's going to affect tourism.
That's really interesting. And then finally, I do want to ask you about the holidays and what you expect in terms of this sort of high-end, low-end, or I should say high-income consumer, low-income consumer dichotomy, and what you expect, how you expect that to play out over the holidays.
Yeah. So the one segment of luxury, which we haven't talked about a lot on this show in the past, is luxury experiences. That seems, untouchable. People are spending a lot. Luxury hotels are still, raising their prices and getting away with it. People's interest in traveling, and not just to the obvious places like Paris or New York or London, but even to off the beaten path, adventure holidays. I think that the spending around that is going to be quite good, especially at the very high end. In terms of goods, I think it's going to be very industry specific. I think jewelry continues to be a standout, in part because, as we saw from the Paris heist, that there's underlying value that is saleable, which you don't see so much in fashion and handbags. So I think it's going to be very industry specific. The other category that definitely has had momentum over the last 2 years or so and is continuing is specialty fragrances.
Pauline, good to see you. Thanks so much.
Thank you.
We got more markets action coming up. Stay tuned. You're watching Market Catalyst. Southwest Airlines posted a surprise profit and record third quarter operating revenue as it continues to implement changes, including charging for bags and adding seat assignments. The airline expects the trend to continue, maintaining its full-year outlook and anticipating record holiday revenue. For more on what's next for the airline, I'm joined by Tom Doxey, Southwest Airlines Chief Financial Officer. Tom, it's great to see you.
Hi, Julie. Good to see you again.
So let's talk about that unexpected profit. Analysts have been looking for a loss. You guys posted a profit in the quarter. How much of that do you attribute to this introduction of baggage fees? How much to demand? Break it down for us.
So we beat on cost and we beat from the midpoint of our revenue guide as well. And you're right, flipped from what was expected to be a modest loss to a nice solid gain. And that's everything from, you think of the different initiatives that we've rolled out here recently. It's everything from the bag fees to the amended deal that we did with Chase. These initiatives that we have are on track, they're working, and we're seeing that roll into earnings.
On the baggage fee front, have you all gotten any pushback at all from customers?
We track, as you know, Southwest, we pride ourselves on the interactions that we have with the customers. And we have seen our brand net promoter score return to levels that they were at prior to the announcement of some of these initiatives back in March, which is great to see. And, we've had a steady rollout of a lot of different initiatives in addition to bags as well. Things like free Wi-Fi, which rolls out this month in a partnership that we have with T-Mobile. New markets that we've announced. We announced Anchorage. We've announced some Caribbean markets. We've got new interiors that are rolling out as well. In-seat power, bigger bins, new lighting, extra legroom seats, which we started selling in July that will start operating at the beginning of next year. So there's a lot happening here, and it's, I think, really resonating with our customers.
I have just, out of curiosity, a process question. When you've never charged bag fees and you start charging bag fees, how does that change what bags people bring? Are you seeing people bring fewer bags, for example?
It's almost exactly what we would have expected, yes. So as you charge for bags, of course, there's revenue that comes in for the bags that are checked. But we also assumed that we would have a reduction overall in bags, and we've seen that. So that's about a 1/3 reduction in the quantity, which is right in line with our expectation there. And that helps our operation as well. So that helps us to turn airplanes more quickly and just sort of streamlines things for us, what we call below the wing.
Tom, as you mentioned, you're doing a lot of other changes, including changing your seating process. That changes effective late January for stuff that people are booking now. That must be a big sort of internal infrastructure change. What's the biggest thing you guys are focusing on there?
It is, and we started selling that back in July, and that's for flights that will be at the end of January and beyond. And so we're starting to see those sales come in. Everything is as we would have expected. And you know, when we think of those that are choosing not to fly us today, I think this is a really interesting stat. 85% of those who have chosen not to fly us today, they say that it's the boarding process and the lack of assigned seats that is the number one reason. Of course, we want to eliminate any reason that somebody has not to fly on the airline. And so we're really excited, and this is resonating with people. We're seeing it in the sales numbers so far. As far as processes, you know, there's a new boarding process that we'll have that I think will look similar to what customers are used to with other airlines. But more than anything, it's that assurity that you have that when you're, you know, if you're the first person on the plane or the last person on the plane, you know what seat you're going to be sitting in, and I think that that'll really resonate with both our current customers as well as those that are choosing not to fly us today, which I think will start to fly us a bit more than they had in the past.
Right. Well, they're used to it elsewhere, certainly. Tom, the fourth quarter forecast for record operating revenue, unit revenue, to rise 1% to 3%, and you all mentioned in the release that includes factoring in the effects of the government shutdown. So I'm curious what your sort of base case assumptions are around the shutdown that you're factoring in there.
Yeah, it's relatively modest, and so I think that was just sort of a minor comment that the modest impact that we're seeing now is included within the guides that we gave. So far, no major impact relating to the shutdown.
Do you have sort of a worst case scenario, though, that you're also preparing for? Because that shutdown, it's not showing any sign of ending. We have started to see some signs of stress in the system. As the air traffic controllers maybe are not getting paid, we might see more sick out. So how are you all preparing for that potential?
Yeah, so first off, you mentioned those that are out working. I want to make sure that we thank those folks that are out there, not receiving pay for the work that they're doing. They are professionals. They are incredible. Please thank them as you're traveling for what they're doing. As far as what we're looking at, again, everything that we've seen so far has been really modest and is contemplated within the numbers there. Of course, we'll continue to monitor and see if we see further impact, but so far, everything that we're seeing is contemplated within our guidance.
And finally, Tom, I'm curious just in general what you guys are seeing in terms of demand. I mean, implied in the numbers is sort of that demand is going to grow to some extent, but can you give me a little color around that and whether you're seeing any pockets of weakness?
We saw an inflection back, positive inflection in July, and that held quite steadily through the quarter. Again, I mentioned that we had a beat on revenue for the third quarter, and so that strength that we saw in July contributed to that, of course. Our assumption as we go forward into the fourth quarter, continue through the fourth quarter, is that same revenue environment continues on. And you think about some of the things that we've already announced. I think another thing that's really exciting for us, we have been not so subtly hinting at future potential product items that we're looking at. Things like clubs, things like first class, things like international. Nothing to announce today, but we are continuing to evaluate those things as we look at some of the premium revenue streams that the other airlines have had the ability to participate in. Those types of things at least need to be considered as we move forward so that we have that potential to participate in those more premium revenue streams as well.